Assalamu alaikum listeners, welcome back to the recording of chapter number 15. It's about long-term liabilities. We have already discussed about the theory content of this chapter, and we all know that in this chapter we are going to discuss two types of long-term liabilities. We will be talking about bonds and we will be talking about notes payable. Okay, both of them are liabilities, so they are payable. Okay. Let's move on towards our first exercise, which we will be solving together. That is exercise number 15-2. On January 1st, 2017, Cholesterol Man Company issued $500,000 10% 10 years bond at face value. Now we know that bonds could be issued at face value, and we issue them at face value when the bond rate or the contractual rate is equal to the market rate. We can also issue the bonds at discount, and we issue the bonds at discount when contractual rate is less than market rate. Market is offering higher rates. People will be interested in investing in market bonds, not your bonds. In order to make your bonds attractive, you can issue them at discount. Then you can also issue the bonds at premium, and we issue the bonds at premium when the contractual rate is higher than the market rate. Market is giving less interest, your bonds are having more interest on them. People will be attracted towards, or investor will be willing to invest in your bonds, and for that sake, you, because it's a premium product, you can offer it at higher prices. So remember this logic. Okay. So if you see over here, Cholesterol Man Company, they issued the bonds at face value. So it means that the bond contractual rate, which is 10%, that was equal to the market rate. That's why we are issuing at face value. Anyways, the interest is payable annually on January 1st. A company will never pay the interest at the start of the year. Like let's suppose on January 1st, 2017, they borrowed the money and they issued the bond 500,000. January 1st, 2017 is not the payment date of interest. Interest will be due at December 31st, 2017, and then January 1st, 2018 is the payment date of interest. So remember these things. Okay, let's start. What is the requirement? Prepare the journal entries to record the following. Number 1, issuance of the bond. You are issuing these bonds at face value, so you get the money. Cash gets debit and bonds payable get credit with 500,000 and 500,000. Then point number B says that the accrual of interest on December 31st, 2017. Interest will be due at the end of the year, but the payment will be next day. So let's make it accrued and record our interest expense. For this, we need to do some calculations first. So if you see over here, we did it. The face value of the bond was 500,000. Contractual interest rate is 10%. So 10% of 500,000 is 50,000. So interest expense gets debit, interest payable gets credit 50,000. And this is the interest you will be paying next day, which is January 1st, 2018. So this liability will come to an end. You will debit it and cash will be paid out. Let's move on towards the next question, which is on the same scale. Let's read it. Exercise number 15-3. On January 1st, 2017, Forrester Company issued $400,000 8% 5 years bond at face value. Why face value? Because market rate will be equal to your bond rate. Your bond rate is 8%. Interest is payable annually on January 1st. So prepare the journal entry for the issuance of the bond. So when you issue the bonds, if you see here, the face value is 400,000. So you get the money, cash gets debit, bonds payable gets credit, 400,000, 400,000. The accrual of interest on December 31st, 2017. So let's calculate the interest. 400,000 is our bonds value, Interest rate is 8%, so just multiply. Even if you don't write this, it doesn't make any sense. Just 8% multiplied by 400,000, and then when you multiply it, you get interest expense 32,000, and it's 31st December. It's not the payment date, so it becomes our liability. And the next day on that, we have to do point number C. They say that do the recording for the payment of interest on January 1st 2018. So this interest payable, which was our liability, it will be paid on January 1st and cash will be paid out. Exactly the same question like you did in exercise number 15-2. Let's move on towards exercise number 15-4. Lodi Company issued $400,000 9% 10 years bond on January 1st 2017 at face value. Again face value. Interest is payable annually on January 1st 2018. So number 1, prepare the journal entry for the issuance of the bond. So when the bonds are issued, we get 400,000 cash, so cash gets debit and bonds payable gets credit, 400,000. Then you have December 31st 2017 accrual of interest you have to record. So I'm recording it over here. Interest expense gets debit, interest payable gets credit, and 9% is the contractual rate. Value is 400,000. So when I multiply them, I get 36,000 as interest expense and interest payable. Point number C says that the payment of interest on January 1st. So we all know interest payable will get debit and cash will get credit. Point number D, the redemption of bonds at maturity. So at maturity, face value will be returned, right? And redemption means retirement. So you return the money of the bondholders and the cash is paid out. But we need to think that is the last year interest expense is being paid. So can you see here, assuming interest for the last interest period has been paid and recorded. So you don't need to record the journal entry for the interest. It is already recorded and it is already paid. You issued the bonds at January 1st 2017 and the life was 10 years. So 2027 is the maturity. So if you see here, 2027, bonds payable gets debit and cash gets credit, 400,000 and 400,000. Let's move on towards the next question, which is exercise number 15-5. Swisher Company issued $2 million of bond on January 1st 2017. They didn't say at face value or discount or premium. So let's read the instructions. Instruction says that prepare the journal entry to record the issuance of the bond if they are issued at 100. Remember what did I say? 100 means, if you see here, 100 means face value. Less than before 100 means less than 100, like let's suppose 98, 99 or any other which is number less than 100, that means at discount. And if the number is greater than 100, like 101, 102, 105, 107 and so on, they are at premium, means the price was above 100%. We don't write 100% or 98% or 102%. No, we write 100, 98, 99, 101 like that without percentage sign. So we automatically understand that it is by default percentage. So if you see here, we have first option 100. So it means that at face value. So what was face value? 2 million. Second journal entry, which is required at 98. 98 is less than 100. It means at discount. So we will take 98% of 2 million and we will know how much money we get. 103 means above 100%. So it means it's premium. So we will take 103% of 2 million. Right? So let's record all the three journal entries. Then we will solve the remaining requirements. So number one, issued at par. So when this is the case, cash gets debit, bonds payable gets credit 2 million, and 2 million is the par value. Point number B says that means it's A2 says 98, and I put the percentage here so that you know that it's percent. Cash gets debit. How much cash you get? You get 98% of the bonds. So bonds were 2 million. So 2 million multiplied by 98%, that is 1,960,000. And bonds payable, they are recorded at face value, so that's 2 million. So how much money you did not collected, that is discount on bonds payable. So 40,000 you was not able to collect because of the discount. Point number 3 was you issued them at 103. 103 means it was at premium. So cash gets debit with 103% of 2 million, so that comes up to 1,060,000. Bonds payable gets credit again with its face value. If you see, if it's over here, and the extra money which you are charging, that is premium on bonds payable. It's over here, it's typo. Okay, let's read requirement number 2. Requirement number 2 says that prepare the journal entry to record the redemption of the bond at maturity. Assuming the bond were issued at 100, so at maturity when you redeem the bond, even if it is premium or discount, complete face value is being paid. Okay, so if you see over here, but out of the first 3 options in the previous part, they say assume that you issued the bonds at 100. So clearly we will pay the cash face value and cash will decrease, bonds payable will be removed. So see here, bonds payable debit and cash gets credit 2 million and 2 million. Let's read transaction number C. Prepare the journal entry to record the redemption of the bond before maturity. Whenever you issue the bonds and you're going to redeem them before maturity, do remember if the bonds were issued at discount or at premium and you are redeeming them before maturity, so you will always have some balance in the discount account or premium account. So while removing the bonds payable from your books at before maturity, don't forget to remove the discount or premium account. Okay, whichever was present. So let's see here. Prepare the journal entry to record the redemption of the bonds before maturity at 98. So if you see here, you have redeemed them 98. Assume that the balance in the premium of the bonds payable is 900,000. Now don't get confused with this 98. This 98 is the price you paid before maturity, but actually these bonds were the premium bonds. That's why you still have some balance in the premium account. Okay, so that balance was 9,000. So when you will remove these bonds from your books, you have to remove this 9,000 as well, because no more bonds, so no more their premium account. Okay, and how much money you are paying them? You are paying them 98. So 98 is the value of the bond which you are paying them. So let's quickly solve this. Your bonds will be removed. When you are removing the bonds, the face value of the bonds were 2 million. We have to remove the premium or the discount as well. The normal balance of premium is credit. When you are removing it, you will be debiting the premium. And they told us the balance. They said 9,000 is there. So let's remove the balance. You get cash. How much cash? You get cash of 98 for the full value. Right? So 98 of 2 million is 1,960,000. So if you remember, whenever we sell any asset, we always compare its book value with the cash we receive, and we decide, do we have a gain or a loss? Same is the case with the redemption of the bonds. You might have gain or loss at the redemption, How would you know? You will be comparing the carrying value of the bond with the cash you are paying. What is carrying value? We discussed about it. Carrying value is face value less discount or face value sorry face value plus premium if the bond was issued on premium. Okay, in this question we had the bond on the premium, so the face value plus the premium together, they will tell me that how much was the value of the carrying value of the bond. If you see, it will be 2,900,000. Okay, so if the carrying value is more than cash payment, it means that you are paying less than what actually you were supposed to pay. So you saved your money, so you will be having a gain on redemption. But if the carrying value is less but you are paying more cash, then in that case you are at loss because you are paying more. So actually the redemption of the bonds is opposite to the sale of assets, because assets and liabilities, they both are opposite to each other. Okay, so do remember, if the carrying value was more than the cash payment, you saved some money, so it's a gain on redemption. If the carrying value was less than the cash, then in that case you have a loss because you paid more than what you were supposed to pay. Right? So in this question which I'm solving with you, your carrying value is 2,900,000. How much cash you are paying? You are paying 1,960,000. You are paying less. How much less? 49,000 less. So that is gain on redemption of bonds. Okay, let's move on towards point number D. Prepare the journal entry to record the conversion of bonds into 60,000 shares of $10 par value common stock. Assume that the bonds were issued at par. So the value of the bond was 2 million. So let's redeem. If you remember, when I was discussing the theory content of this chapter, I told you that conversion does not have gain or loss. In case of conversion, we add extra stuff in paid in capital account. Loss or gain comes only in case of redemption. So bonds payable gets debit. The value of the bond was 2 million and you issued the common stock. You issued 60,000 shares and the par value of share is 10. You know that common stock, preferred stock are always recorded at par or stated value. So 600,000. So rest will go where? Remaining. Don't consider it gain or loss. It is additional paid in capital. So paid in capital in excess of par common stock, that is 1,400,000. Let's move on towards next question, which is exercise number 15-6. Whitemore Company issued $500,000 of 5 years 8% bond at 98 on January 1st, 97. At January 1st, 2017, 97 is less than 100. It means that bonds were issued at discount. They want us to record the journal entry to record the issuance of the bond, and then they want us to calculate the cost of borrowing for these bonds. Okay, so let's do these two things. Point number A, part 1, record the journal entry. So cash gets debit. How much cash gets debit? 500,000 was the face value of the bond. You issued them at 97, so that is 485,000. Bonds payable gets credit 500,000. The difference is discount on bonds payable. Cost of borrowing. When we discussed this topic, we said that cost of borrowing includes whatever you pay over or additional to what you borrowed. Let's suppose if you borrowed 1,000 and you pay 1,200, so you are paying 200 extra. This is cost for you. Okay, so This money which you are paying, it could include interest, it could include the discount which you did not collect from the people but you have to pay at maturity, or it could include interest, but this interest will decrease because you issued the bonds at premium, and premium is a sort of savings, right? So minus premium. Here interest plus discount. So let's do this. This one is at discount, so our cost of borrowing will be interest plus discount together. Do remember the rate of interest, that's 8%, okay, and the life is 5 years. So let's do the calculation. How much interest you are paying? 40,000 is the value of the bond. Sorry, not 40,000, it's actually 500,000. Sorry, 500,000 is the value of the bond, and 8% is the rate of interest. So 40,000 is annual interest on the bond, but the life of the bond is 5 years. So you will be paying this 40,000 for 5 years. So altogether, how much interest you pay? 200,000. But this bond was issued at discount. You collected only 485,000, but at maturity you have to give 500,000. So this discount you have to also pay from your pocket, just like interest. So interest plus the discount on bond together, they are your cost of borrowing, that is 215,000. Another way to do is that write all the payments you will be making and minus what you collected from the bondholders. So let's do that way as well. What payments you are going to make? You will be returning the bond value to the people. Also, you will be paying interest to the people. So together you will be paying 700,000. But how much money you collected from the people? You only collected 485,000. So minus 485,000, rest is going from your pocket, which is 215,000. It's went, when I converted it into PDF, it went ahead, so it's not here, it's here. Okay, let's move on towards part B. Part B says that repeat the requirements from part A. So these two requirements, journal entry for the issuance and cost of borrowing. What is changed? Assume that the bonds were issued at 105. 105 is above 100%. It means you issued them at premium. So let's record the journal entry first. You get the cash. Cash gets debit 105% of the value of the bond, which is 500,000. So you collected the money of 525,000. Bonds payable gets credit 500,000. You charge extra money from the people, that is 25,000, that is premium on bonds payable. Let's calculate the cost of borrowing. You have to pay the interest to them throughout the year. I did this calculation in the previous part, that is 200,000 for 5 years. But you are saving some money, that is 25,000, which you don't need to pay at maturity. You took it from the people, but you will not return it to the people. You will only return the face value. So this saving reduces your cost. So when it is reducing your cost, you don't need to pay 200,000 complete. You only need to pay 175,000 from your pocket. Again, you can do it in another way. Put all the payments which you are going to make minus what you collected from the people. So you are going to make the payment of the principal at maturity. You are going to make all the interest payments. Altogether, you are going to pay them 700,000. But you collected this 700,000 is not from your complete from your pocket. You are returning 525,000 of people which you already borrowed from them. So this money was people's money, not yours. Rest is yours. That is going from your pocket. That is 175,000. I hope it is clear to you. Let's move on to the problem exercise, which is 15-1. On May 1st, 2017, Heron Corporation issued $600,000 9% 5 years bond at face value. The bonds were dated May 1st, 2017 and pay interest annually on May 1st. Financial statements are prepared annually on December 31st. This is the point. Because in all the questions which we did till now, the bonds were issued at January 1st. But now we are issuing the bonds in the second quarter of the year. Right? So it means in the first year we are not eligible for whole year annual interest expense. We only need to charge few months interest expense. Right? Let's do it together. Let's make the journal entry for preparing the issuance of the bonds. So that's very simple. Cash gets debit, bonds payable gets credit, 600,000. Point number B, prepare the adjusting entry to record the accrual of interest on December 31st, 2017. So interest expense gets debit, interest payable gets credit. Let's calculate. 600,000 is the value of the bond. Rate of interest is 9%, but this is annual. We issued the bond on May 1st. So we need to pay the interest for May, June, July, August, September, October, November and December. On December 31st, these months' interest is accrued only. How many months are there? There are 8 months. Right? So don't forget to put the partial year factor. So let's do this over here. 600,000 was the value of the bond, 9% is the rate, and 8 by 12 because partial year factor. So that is 36,000 interest expense and 36,000 interest payable. They want us in part C to show the balance sheet presentation on December 31st, 2017, the same date. So on this date we have bonds payable and we also have interest payable because we did not pay it yet. So in the current liabilities, interest payable will appear, and in long-term liabilities, bonds payable will appear with its face value. Moving on towards point number D. Point number D says that prepare the journal entry to record the payment of interest on May 1st, 2018. So do remember, December 31st we already recorded some of the interest expense which was for 8 months. Right? Still 4 months which are, see, January, February, March and April, we did not record their interest, and May 1st you are making the payment. So it means that we have to make the payment of this interest expense as well. But it's not the end of the year that we make an accrual. We will record interest expense and immediately we will pay the money for that. Okay, so this interest payable is from the closing entry, 36,000. So now we are going to pay this liability, but 4 months interest was not recorded. So let's record interest expense, make it debit. Your face value was 600,000, 9% is the rate, 4 months we have to record, so 18,000. So together we will be paying 54,000. Point number E. Prepare the adjusting entry to record the accrual of interest on December 31st, 2018. Till April we paid, right? Now again May, June, July, August, September, October, November, December, 8 months again. So the same journal entry which you did in point number C, because here also 8 months, right? So here also 8 months, same, exactly the same calculation, same journal entry, only the year is different. Okay, moving on towards point number F. Assume that on January 1st, 2019, Heron pay the accrual bond interest and calls the bond. Calls means purchase backs the bonds. The purchase price is 102. So record the payment of the interest and the redemption of the bonds. So let's pay the interest. Do remember these bonds were issued at face value, so we will not have any premium or discount. So carrying value will be actually the face value. Okay, and you are paying 102. And you need to pay the interest as well. So let's do this recording. It's missing, so let's do it over here. I'm sorry, it's not recorded. So let's do together. So interest expense gets debit. Okay, um, sorry, interest payable gets debit because it's what is the date? The date is um, January 1st, so accrual is already done last day, right? Here you already did the accrual, so interest payable, I need to erase it. Yes, so interest payable which was accrued last day, so interest payable is going to be debit 36,000. And then you have to debit the bonds payable as well. What is the value? 600,000, right? And then you will pay cash, but we need to see that do we have a gain or a loss. So basically for 600,000 you are paying 10, how much was that? 102%. You are paying above 100%, right? So that here in this case you will have a loss on redemption. So I'm gonna erase this cash, put it little down so that I have a place for writing loss on redemption of the bond. So loss on redemption of bonds, it will also get debit, cash gets credit, this money plus the interest 36,000 which you are going to pay. Okay, so when you do this you will get a value of, let's quickly do these 5 zeros, and this is the money which you will pay for the bonds. Sorry, not this one. 612,000 you will pay for the bonds, and plus this 36,000. So together, this is together money which you will be paying. So that will be 648,000 cash. So I'll be writing this cash over here, 648,000. Okay, and you have a loss of how much? 12,000. Why 12,000 loss? Because you are paying for bond 612,000, but the value, carrying value of the bond was only 600,000. So like this you can do, or you can do it in 2 steps. Like we always say, we can go for the single entry instead of doing this compound entry. So the single entry will be make the payment of interest payable. So interest payable will get debit. You can either do this choice or you can do point number this choice, which I'm going to do now. Interest payable gets debit and cash gets credit, 36,000 and 36,000. Okay, and now interest is gone. Let's redeem the bonds. So again, second journal entry, bonds payable gets debit with their value 600,000, but you are paying a cash of 612,000. So 12,000 which you are paying extra, that is loss on redemption of bonds. Write the complete. Okay, so you have a choice, either you pass 2 entries single, or you can pass one combined entry for the whole scenario. So this is it about the exercises of chapter number 15. Hope you understand them. If you have any questions, you can write them in the comment section. And if you want to listen to the next recordings, please subscribe to the channel so that you get a notification when I upload the new video for you. Okay, take care everyone.